All right, today we are taking a deep dive into Monday.com. It's a company that has been on a lot of investors' radars, especially after its stock took a pretty wild ride recently. We're going to break down what they do, look at the bull and bear cases, and try to figure out what this all means if you're thinking about investing.
So get this, a company posts what seems like pretty solid earnings, but then its stock just tanks by 30% in a single day. That is exactly what happened with Monday.com. So the big question is, was that just a massive overreaction from the market, maybe creating a bargain? Or was it a serious red flag about what's to come? That's really the core puzzle we're trying to solve here.
Okay, so first things first, let's get a clear picture of what Monday.com actually is. At its heart, it's a platform they've designed to be the central hub for how an entire business operates. They call it the Work OS.
And the best way to understand this is to look at how they define it in their own filings. The key words here are no-code and low-code. Now, this is absolutely crucial. It means you don't have to be a software developer to build custom tools on their platform. The whole idea is to give any team in any department the power to create the exact workflows they need, rather than being stuck with some rigid, one-size-fits-all software.
And that core Work OS is the foundation for a whole family of products. They're going after everything, from your basic project management and sales CRMs, all the way to specialized tools for software developers and customer service teams. And then they throw in things like digital whiteboards and form builders. It's pretty clear their goal is to be the only software a company needs for its day-to-day work. So now that we know what it is, let's get into the optimistic view, the bull case for Monday.com. And this side of the story is all about one thing: incredible, high-speed growth and a really smart shift towards bigger and bigger customers. The first number that should really make you sit up and pay attention is this one: 112%. That's their net dollar retention rate. In simple terms, it means that the customers they already have are spending 12% more this year than they did last year. That's huge. It shows the product is sticky and that Monday.com is really good at getting customers to use it more. And that stickiness is helping them land some very big fish. Right now, the company has over 3,200 enterprise customers, each paying them more than $50,000 a year. For a software-as-a-service company, these big, stable accounts are the holy grail. They provide that predictable, long-term revenue that investors love to see. And look, this isn't just the company bragging. Independent analysts are seeing the same thing. This quote from Morningstar really backs up the bull case, saying Monday.com is gaining real traction in that sticky enterprise market and has a clear runway to keep growing by selling more to those big customers they already have. And just to put all this growth into perspective, check out the size of the playground they're in. Monday.com believes their total addressable market is going to balloon to $150 billion by 2026. So the message here is pretty clear. Even with all their success so far, they've barely even scratched the surface of what's possible.
Okay, that's the good news. But, every investment story has another side. And the bear case for Monday.com, well, it pretty much boils down to one major theme: fierce, intense competition, especially in that critical race to win over the big enterprise clients.
Let's make this competition real by putting them side by side with a major rival, Smartsheet. Now, Monday.com is in 61% of the Fortune 500, which sounds great until you see that Smartsheet is already in 85%. And when you look at the really big accounts, the ones spending over $100,000 a year, Smartsheet has more than double what Monday.com has. That shows you the kind of ground they still need to make up. And the Morningstar analyst really doesn't pull any punches here. The worry is twofold. First, they're behind in the big leagues, in that enterprise race. And second, a big chunk of their business still comes from small and medium-sized businesses, the SMB market. And those smaller customers are just generally less stable and more likely to cancel their subscriptions than a giant corporation. What's interesting is the company is actually very open about these risks in its own legal filings. They point directly to increasing competition as a top concern. They also know that their success hinges on being able to grow their sales force on a global scale, which is a massive challenge. Plus, they have to deal with all the risks that come with operating overseas and trying to integrate other companies they might buy down the road. These are some serious headwinds. So, you've got this incredible growth engine on one side and these really significant competitive threats on the other. How on earth does an analyst balance all of that? Well, let's see how Morningstar takes this tug of war and turns it into an actual number. And here's the number that jumps off the page. After weighing all the pros and cons, the analyst lands on a fair value estimate of $306 per share.
When you compare that to its recent price of around $172, wow, that is a huge potential upside. It really suggests that, in this analyst's opinion, the market has been way too pessimistic lately.
But, and this is a really, really important but, that super optimistic price target comes with some serious warnings attached. The analyst gives Monday.com no economic moat. That means they don't believe the company has a durable, long-term competitive advantage just yet. They also rate the stock's uncertainty as very high. So what does that combo mean? It means the potential reward could be huge, but the road to get there is going to be incredibly rocky and full of risk. And that whole valuation is built on these two key predictions. The analyst is forecasting a very strong 23% average annual revenue growth over the next 5 years. But just as important, they're also expecting a massive swing to profitability, with operating margins going from -2% all the way up to a positive 9%. Pulling off both of those things, high growth and improving profits, that is the central challenge and the central opportunity for this company.
So after going through all of that, the bull case, the bear case, the numbers, it all comes down to one single overarching question. This is the main tension that every investor really needs to keep their eye on.
Can this company's flexible, innovative platform let it outsmart and outmaneuver its rivals to win that incredibly lucrative enterprise market? Or are the more established players, the ones with deeper roots in big companies, going to use their size and scale to close the gap and ultimately squeeze them out? The answer to that question will almost certainly decide whether Monday.com's stock price today is a warning sign or one heck of a buying opportunity.